Okay, let's dive right in. We're looking at a market that seems to be, well, fundamentally running on empty. The Coeur office market. It's caught in this really fascinating, almost strange dynamic. There's zero new construction happening, yet there's this persistent demand that's actually causing the biggest rent jumps in the oldest, lowest star buildings. It feels backwards.
It really does. It's kind of the definition of a scarcity premium, isn't it? And it tells us a lot about who the local tenant is right now. They seem focused almost entirely on cost, which is, driving up the price of those value assets while the premium space just sort of sits there.
Welcome to the deep dive. Today, we're cutting straight to the most important data from the Q3 2025 market report for the Coeur d'Alene, Idaho office market.
Really?
This region, famous for its beautiful scenery and more recently, this pretty intense population boom. Our mission today is simple. Pull out the major trends, the notable transactions from Q3, and give you the actionable insights you need. And we'll do it in under 15 minutes.
Right. And just to be clear, all the figures and the analysis we'll talk about today come directly, exclusively from that Q3 2025 market report. We're here to help you sort of navigate this very tight market environment.
Exactly. And look, if you need to talk strategy, maybe get a custom breakdown, or just dig deeper into the actual raw data we're discussing, the point of contact for this report is Eric Peterson. You can reach him directly. His number is 50903-9077.
Okay, so let's try and boil a quarter down into maybe three key headlines. First, and this is the big one, the supply crunch. It's just the dominating factor. Zero new office space delivered. And critically, 0 square feet currently under construction.
Zero. Still find that number pretty shocking, considering how popular the area is.
It creates enormous pressure. Second point, the demand pressure. Even with no new space, net absorption for the trailing 12 months, so looking back a year, was 84,100 square feet. This kind of background demand drove the overall vacancy rate down to a really tight 4.7%. That's a 1.3% drop year over year.
So space is getting snapped up slowly but surely, and absolutely nothing is coming online to replace it.
Precisely. And third, rent growth disparity. The overall market asking rent grew about 2.0% year over year, landing at $22.25 per square foot. But the really crucial thing here, the nuance, is that this growth wasn't led by fancy Class A buildings. It was really fueled by strong demand for, value-priced assets. And finally, just quickly, capital. Transaction volume. Well, it's still muted compared to, say, pre-2023 peaks. Sales volume over the last 12 months was only about $9.8 million. So if you remember just one thing from Q3, the market is defined by this tightly controlled supply meeting very cost-conscious demand. And that's in fleeting rents for functional, affordable space.
Okay, that sets the stage really well for our first deep dive. Let's talk about that construction pipeline, or lack thereof. You mentioned a 0 square foot pipeline. The report compares that to a 10-year average of 31,000 square feet typically under construction. What's behind that complete halt? Is it land costs, materials, or are lenders just, too nervous right now?
Well, it's likely a mix of all those things, really. High construction costs, financing challenges. But for the listener, the impact is straightforward. The existing inventory, about 6.3 million square feet, that's all there is. Nothing new is coming. Developers just aren't incentivized enough right now to tackle those high costs, especially when, as we said, tenants are clearly prioritizing lower total occupancy costs over brand new buildings. The risk-reward just isn't there for them yet.
What I find a bit confusing, though, is the difference between those long-term demand numbers and the quarterly activity. That 84,100 square feet of net absorption over 12 months, that sounds pretty strong, right?
It does.
But then you look at Q3 2025 alone, and the actual net absorption was, what, just over 2,100 square feet? Very modest. What's that telling us?
Yeah, that's a really important distinction, and it's kind of the key nuance for this specific quarter. The 84,000 over the last year shows there is sustained demand generally, probably driven by the region's overall economic health. But that tiny Q3 number, just over 2,000 feet, it basically confirms the market is, well, kind of exhausted.
Exhausted. How so?
Exhausted in terms of available space. That year-over-year vacancy drop, remember, it went from 6.3% last year down to 4.7%. Now that's almost entirely because of the supply constraint. It's not because of sudden huge leasing deals happening. It just means the remaining available space is being slowly leased up, often by smaller tenants. There aren't large blocks of space left to make a big dent in absorption figures quarter to quarter. The market just doesn't have much left to give right now.
And if we link this back to the bigger picture, the report does mention Kootenai County is still growing demographically. Population growth is stable at around 1.7% annually. These are people, businesses, often moving in from more expensive places out west. It feels like something has to give, doesn't it?
Absolutely. That population growth provides the underlying demand, but with no new supply outlet, it just tightens the screws on what's already there. So the key thing to watch is, how long can this demographic pressure build before it just becomes unavoidable, economically viable for a developer to finally break ground, even with today's challenges? Because the existing buildings can't absorb that influx forever.
Right, that pressure cooker effect. Which leads us nicely into our second deep dive, this counterintuitive rent growth disparity. Overall rent growth, 2.0% year over year, looks healthy enough. But drilling down, this is where it gets really interesting. It shows exactly what tenants are prioritizing.
Yeah, the classic example really of tenants choosing lower total occupancy costs over, say, premium amenities or a fancy lobby. Let's break down that split.
Okay, start at the top. The premium end, 4- and 5-star buildings. What happened there?
Rents were completely flat.
Yeah.
0% growth year over year. They're averaging around $29.77 per square foot. It suggests that the group of tenants who absolutely need that high-end Class A space is either small or maybe just being very cautious right now.
Okay, flat at the top. But then the complete opposite happened at the other end of the spectrum. The oldest, most basic properties, the 1- and 2-star buildings, they saw the highest growth rate.
That's right, 3.0% growth year over year. Pushed their average rent up to $20.22 per square foot.
Why such strong growth in that, value segment?
It's a really clear signal. Demand is just heavily concentrated on affordability right now. Think about if you're a small service provider, maybe a regional back office, a nonprofit. You primarily need functional space that fits the budget. And
Right.
because there's no new supply coming online, the pressure just shifts to the available value properties. Tenants are essentially bidding up the price for these older, more affordable buildings. They realize it's maybe the only way to get lower total occupancy costs in this market. The 3-star buildings, by the way, saw moderate growth, 1.1%, averaging about $24.83, right in the middle, as you'd sort of expect.
So the market's screaming that the cost of the space matters more than the quality of the coffee machine in the lobby, maybe.
Something like that, yeah.
Did the report point to any specific submarkets where this value pressure was strongest?
It did, yeah. The Hayden-Dalton Garden submarket actually saw the highest 12-month rent growth across the whole market. It clocked in at 6.0%. And that submarket tends to have a higher concentration of exactly that kind of functional, value-oriented inventory. So it perfectly illustrates where that tenant demand is really focusing.
That kind of pressure must show up on the capital side, too. Let's shift gears to transactions. How careful are investors being, and what's actually managing to trade hands?
Investors are definitely being highly selective. Year to date, so through Q3 2025, the market saw 19 deals close, totaling about $9.5 million. If you compare that to peak years, it's pretty quiet. Investors seem to be waiting maybe for more clarity on interest rates, or they're just finding it tough to underwrite deals with the current cost of debt.
Was there a standout deal in Q3, something that gives us some solid pricing info?
Yeah, the most significant one, confirmed as an investment sale in Q3, closed in August, it was the Wayne building. It's a decent size, 27,593 square feet. It traded for $4.35 million. That works out to about $158 per square foot.
$158 a foot. That sounds pretty healthy for this market, especially when the report's overall estimated market average is, well, much lower. What made the Wayne building stand out?
One word, certainty. That's really the whole story there. The deal closed at a very tight 5.0% cap rate. Now, the reason the cap rate is so low, meaning the price is high relative to the income, is because the property was 100% occupied at the time of sale, 0 vacancy. So it was seen as a stabilized, fully leased core asset. In a market where supply risk is a big concern, investors were clearly willing to pay a significant premium for that reliable income stream.
So the Wayne building is kind of like the exception that proves the rule. It's highly desirable, but maybe there aren't many others like it trading. Does that low 5.0% cap rate give a misleading signal for the average investor looking at other buildings?
Oh, it absolutely does not set a precedent for the average building.
Yeah.
And that distinction is really the key takeaway when we look at the capital market snapshot. We saw other sales mentioned in Q3, like properties on West 5th Ave and North Government Way, but the report notes their pricing and cap rates were undisclosed. Often those might be owner-user deals, which don't really reflect general investment sentiment, or maybe they're part of confidential portfolio adjustments. The market is definitely segmented.
Okay, that premium for certainty for stability. That brings us right to this apparent contradiction in the capital markets. We
Yeah.
just talked about a 5% cap deal, but the overall estimated market pricing seems to suggest a lot more risk.
Right. This is where we need to sort of translate the numbers for the listener. The estimated average market price for Coeur office space is pegged quite low at $119 per square foot. Remember, the Wayne building went for $158. Compare that $119 to the national average, which the report cites as $266 per square foot. So CDA is priced low overall, but it seems like there's a lot of perceived risk baked into that number.
And how does the report quantify that risk?
Primarily through the estimated market cap rate. The overall estimated market cap rate is high, 10.7%. Now, put that in context. The national average cap rate is estimated at 9.1%. So 10.7% is significantly higher.
But wait, why would the estimated cap rate be so high if the market's so tight on supply? Shouldn't scarcity lead to lower cap rates, meaning higher prices?
That's the paradox. That high 10.7% estimated cap rate reflects investors pricing in a substantial risk premium for the average or non-stabilized properties in the market. It suggests that for most office buildings, maybe those not fully leased, those needing significant capital upgrades, or facing leasing challenges, investors are demanding a much higher return, essentially a deep discount, to take on the perceived risk. So it creates this really sharp divide. You have the secure, stabilized assets like the Wayne building trading at tight cap rates, say 5%. And then everything else is viewed through a lens requiring much higher returns, like that 10.7% estimate, because of market volatility, financing costs, or future capital needs.
That's a really stark segmentation, almost like two different markets operating at the same time. Okay, let's look ahead then. What does the report forecast for Q4 and into 2026?
Well, the forecast suggests the vacancy rate will stay extremely low. It's projected to stabilize slightly lower for the full year 2025, around 4.5%. Rent growth is predicted to continue steadily, maybe not explosively, but steady, an overall average increase of 1.5% expected for the rest of 2025. And then looking further out, a stronger projection for 2026 with about a 2.8% increase forecast.
Okay, so continued tightness, steady rent growth. What are the, say, two or three most critical things we should be watching as we head into the new year?
First, definitely keep a close eye on that 1- and 2-star rent growth. Was that 3.0% annual growth a peak, or is this sustained pressure the new normal for value tenants? Second, we need to see if the underlying local economic stability, healthcare, education, tourism are strong there, if that can finally start to boost leasing and pull up pricing in that stagnant 4- and 5-star premium segment. Will tenants start needing that space again?
And I guess most fundamentally, watching for any sign, any crack in that zero construction pipeline.
Exactly. Any tangible signs of new development interest popping up, given that ongoing population growth, the market really does feel like it's at a breaking point regarding supply.
It certainly seems that way. Okay, so this deep dive, based entirely on the Q3 2025 market report, really paints a picture of a market squeezed tight by lack of supply. A market where value-focused tenants are paying a scarcity premium and investors, well, they seem willing to pay top dollar, but only for guaranteed cash flow. Which leaves us with a provocative thought. Given those demographic shifts, that 1.7% annual population growth in Kootenai County, how long can a zero construction pipeline actually meet that rising demand before rents really take off across all building classes? When does that 4- and 5-star pricing finally catch up? That seems like the big question for the next quarter.
It really is. And just a reminder, for more detail or a custom breakdown based on the Q3 2025 report data we discussed, you can contact Eric Peterson. His number again is 509-903-9077.
Great stuff. Thanks for listening, and we'll catch you on the next deep dive.